We made a number of changes in our portfolio as a result of our meeting towards the end of December. And so coming into this first quarter of 2025, we are seeing a significant decrease in our overall exposure to international stocks. We are also significantly reducing our exposure to long-term bonds as a result of our concerns with respect to what's going on with the Fed and interest rates in general. And so we wanted to reduce our overall duration. We increased our overall exposure to natural resources. And part of that is because one of the funds that we added was a gold fund. We removed our exposure to metals and mining in general and replaced that in the natural resources segment with a gold fund. It's the first time in a while that we've held gold. Every now and then we find it an attractive possibility, and we decided that this was a good quarter for that. In addition, we have removed our exposure to the COWS ETF, which was a fund that kind of emphasized large U.S. companies with very strong cash positions. And we have replaced it with utility stocks going forward. Now, utility stocks we've used in the past as a bond surrogate. In fact, it was in our intermediate term bond area last quarter. Utilities are kind of interesting because they can serve as both bonds and stocks because they have characteristics of both. And so right now we're relying more on the equity component of that in the large U.S. stock area. We did replace our small cap value fund that we had with a fund in the S&P 600. The S&P 600 is a set of 600 stocks that are small cap stocks. Normally we would represent small cap stocks with the Russell 2000. We will continue to do that, but the S&P 600, those 600 stocks tend to be higher quality than the overall makeup of the Russell 2000. And so we're kind of emphasizing the 600 best companies within the Russell 2000 by having a fund there. We added a REIT for the residential area of REIT so that we can put a little bit of emphasis there and kind of skew our overall REIT portfolio towards the residential area. And we replaced in that intermediate term bond area, when I said we took the utilities and moved them to the equity area, well, in that intermediate term bond area, we once again purchased a fund that we've held at various times in the past for senior loans, which are loans between banks, basically. And finally, we replaced our long-term treasury fund with another long-term treasury fund. The makeup of the funds is almost identical, but we did it so that we could actually realize some losses on the portfolio towards the end of the year. We will repurchase our previous long-term bond fund when we have a sufficient period of time go by that it will not affect you from a tax perspective, and then we will once again, be back to the standard funds that we are normally using in bonds.